Today I want to talk about 5 ways you can hedge your wealth against inflation. But before I do, my name's Kevin Lum. I'm a certified financial planner, and this is a new channel I'm starting called Retirement Made Simple. And if you find this content helpful, I'd appreciate it if you'd share it with your friends and your family. Click the like button. Also subscribe to the channel, and then leave comments. Let me know questions you have, any ways that I can improve. And if it's too harsh, just keep it to yourself. Okay, so here are the 5 things you can do to protect yourself against inflation. Now, before I dive in, I should let you know I'm not going to talk about Bitcoin. Not because Bitcoin isn't a good hedge against inflation. It's simply because we don't have any idea yet whether Bitcoin is a good hedge against inflation. We don't have enough data. And the second thing I want to kind of preface this by is that if you are younger and have a long time horizon, probably the best strategy is just to stay in a balanced equity portfolio. That's going to perform the best over the long period. But if you're nearing retirement, or you need less volatility in your portfolio, or you just want to take a more tactical approach because you want to feel like you're doing something, here are 5 things that I discovered that help hedge against inflation. None of these are a silver bullet. None of these are perfect, and each have a little variation and a bit of nuance, but hopefully it'll at least help you begin to create your own strategy. Nothing I'm saying here should be taken as financial advice. I'm a financial advisor, but I am not your financial advisor. And a lot of the stuff that's that I'm talking about today is actually pulled from a paper called The Best Strategies for Inflationary Times, and I'm going to link to that in the show notes. But the first thing, and this is honestly probably the strategy that more people talk about than almost anything else, but the first thing that people do to hedge against inflation is they sell bonds and buy equities. And the general kind of, idea is that companies should go up in value because they're able to increase cost, and also because the value of their debt load is inflated away. The problem is it's not quite that simple. And if you look at the paper, you can kind of dive into some of the specifics. But companies can increase cost, but also the cost of goods increases. And so the company's cost increases, and the company's costs often increase faster than the company can raise prices. And so companies do not do well. How many times can I say company in a sentence? They don't do well in a short term or in an inflationary environment. But what they did discover, what researchers found, is that there are ways your portfolio can provide a hedge against inflation. First, just a bit of background. When we're creating a portfolio, we start with the market, so kind of the total market, and then we tilt towards certain factors. In our case, we tilt towards size, typically a small cap company or smaller cap companies. We tilt towards value, we tilt towards profitability, and we tilt towards momentum. So we take kind of a market cap weighted portfolio, and then we just overweight each of those areas slightly because historically there's been a better return for portfolios that weight towards those factors. And what the research has found is that both value, momentum, and profitability all perform well during an inflationary period. What has underperformed actually is smaller companies or small cap. And the reason for that is large companies just have more purchasing power. They have more negotiating power. They can put more pressure on their vendors to keep costs low. And when you're a small company, you just don't have near the purchasing power. And also you don't have as much negotiating power with, your debtors, banks, whoever it is that you're working with. So smaller companies can often underperform during an inflationary period. But if you have a portfolio that is tilted towards value, that's tilted towards momentum, in fact, momentum performed quite well during an inflationary period, and then also profitability. All those have done well during an inflationary period. And well, I guess is relative, right? They're not exploding to the upside, but they provide a better return than simply holding a cap-weighted market index. So the first thing that people do is they move from an equity portfolio to a bond portfolio, and then within that equity portfolio, tilting towards value, momentum, and profitability is often or has historically been helpful. Next, diversifying your portfolio internationally. So you want to diversify your portfolio towards particular factors. The next thing that people have done is they diversified their portfolio towards international stocks, because just because your home country has rampant inflation doesn't mean the whole globe has rampant inflation. And so historically, if you've had a portfolio that has exposure to the whole globe, you'll have a better return than simply holding your home country's equities. So the next thing you can do is buy real assets, particularly real estate. Now, real estate has not performed as well in an inflationary period as you might think it has, but it also has held up fairly well. But real assets in general do well. So buying real things and holding those items does well when there's inflation, simply because if you buy something today for $10 and then the price increases and 3 years later it's $13, it's at least kept up with the cost of inflation. So collectibles like wine, I'm trying to think what other, actually stamps, art, all those have done well during inflationary periods of time. Next, while bonds as a kind of overall category have underperformed, and also growth stocks, that's the other thing I didn't mention, growth stocks really underperformed during an inflationary period. Bonds tend to underperform as kind of a general category, but inflation-protected bonds do provide protection from inflation. The problem is you often have to buy your inflation-protected bonds at the first sign of inflation, when people are just beginning to contemplate the possibility that someday there might be inflation. You really need to buy those bonds then, because the inflation is already kind of baked into the price. Now, if inflation continues to rise from this point, that it can be a good strategy. But often if you try to time it and say, okay, now we've got inflation, I should buy, tips or whatever it might be, it won't perform as well as you expect or hope. So the first thing, just to kind of recap as I'm going through these, because the last thing I want to talk about has actually performed better than anything else historically. So first, you want to diversify your portfolio towards certain factors, value and profitability and momentum. The second thing you want to do is potentially, diversify your portfolio globally. The third thing that has worked historically is owning real assets. The fourth thing is buying inflation-protected bonds. And now here, number 5, I don't have the capability, my channel isn't fancy enough yet, but if it was, I'd have a drum roll right here. Number 5 is you want to buy commodities. And when you look at the past 8 periods of significant inflation in US history, commodities have had a real return of 14% on average. And so what that means, real return, so you have nominal returns. So if you look at a portfolio and you see that the S&P 500 has gone up 10%, that's your nominal return. But if that year, if inflation was 8%, your real return, so your return over and above inflation, is only 2%. So the real return, which is after you've taken out taxes and inflation, is 14%, which is just crushes inflation. The problem is commodities are a terrible investment over the long run. So most of us have been trained that the best strategy is to buy equities, to buy stocks, to buy bonds, and just hold them. It's very hard to beat the market trading in and out of different positions. But with commodities, if you hold commodities for a 10-year period of time, the chances are for most of that period, you will actually lose money. So if you do a back test, right, you're trying to create your portfolio through through a back test, and you looked at commodities over the past 10 years, they lost money. And so if your financial advisor had put you in commodities, you would hate your financial advisor because he lost money every year in commodities until this year. Now commodities have exploded to the upside. You have commodity funds that are up 40 to 50%. And so interestingly, one of the best strategies is not only buying commodities, but using something that's called trend following on the commodity sleeve. So, they're creating certain rules that, you're going to buy commodities when these conditions are met, and you're going to sell commodities when these other conditions are met, has done quite well during an inflationary period of time. And so you might want to talk to your financial advisor, ask them if they do trend following, particularly on commodities. Ask them, is there a way that you could tilt my portfolio a little bit towards commodities? Again, it's very similar to, the inflation protected bonds. Commodities have increased dramatically over the past year. If inflation also plummets, that commodities portfolio is probably also going to plummet. On the other hand, if inflation continues to rise, commodities are going to continue to rise. And so this is why if you're young, you're actually safer just holding a balanced equity portfolio and not trying to figure out what's going to happen and not trying to be tactical, because it's really hard to time. And so if you end up buying tips and commodities, and then inflation plummets next month because it turns out, it's all supply chain issues and it's all gone away, then you would have been better off just buying a buy and hold portfolio. On the other hand, if you do put a portion of your portfolio in commodities and tips, and the inflation continues to skyrocket, you're going to have some protection. So it's figuring out what's right for your own situation, talking to your financial advisor. If you have questions, I can't answer specific questions, but if you have any questions, leave them in the comments. And then also you can go to my website if you want to have a conversation, foundryfinancial.org. I geek out in this stuff. I love talking about it. And then in the show notes, if you look below, you'll find the best strategies for inflationary times. It's a 32-page academic paper. That's great reading if you're trying to go to sleep at night, but it dives into a lot of the specifics, like how well did value perform? And it'll give you a breakdown. It'll show you the past 8 inflationary periods. It'll show you how value performed during that period. It'll show you how equities in general performed, how a 60-40 portfolio performed. And so it's really helpful. I'm not going to bore you by going into the deep details today, but if you want to go further, click on the link below. Again, if you enjoy this content, please share it with your friends and family, click like, and subscribe as well. Until next time.